Hello everyone, welcome to Management Study, and today we are going to discuss unit number 4 of paper 2 Management and Commerce UGC and GSET. This course is specifically designed for GSET, but the syllabus of GSET and UGC NET is same in both the paper Commerce and Management. So this unit is a combination of accounting and finance. So to students who are giving planning to give GSET in commerce, and also those who are planning to give it in management, this topic is for both of them. So I hope that you will watch this lecture, and this lecture will surely benefit you in your examination. Okay, so without wasting any time, let's just start it. So first is accounting principles and standards. So in accounting, there are some types of principles and standards that are mandatory to follow. If you are pursuing chartered accountancy course or a company secretary course, then you will study these type of principles and standards. And if you have pursued your BCom, then you also familiar with some of these principles and standards. So what are accounting principles? So accounting principles are basic rules like going concern, accrual, consistency, prudence, and matching, etc. And accounting standards are Indian accounting standards, Indian financial regulatory standards, which is IFRS, and frameworks for preparing and presenting financial statements to ensure comparability, reliability, and transparency. Okay. Preparation of financial statements. So, if you have earlier studied accountancy, then you will know that there are three types of statement that we need to prepare in financial accounting. So, these statements are called trading account, profit and loss account, which is a statement of profit and loss of a firm, and balance sheet. Notes of accounts, which is disclosure if required, and the cash flow statement as per accounting standard 3 and accounting standard 7. Financial statement analysis. So those who are the students of finance, they know that what is financial statement analysis. In financial statement analysis, basically what you do is to do a ratio analysis, fund flow analysis, cash flow analysis, and report analysis. Okay. So why we do financial analysis, or why we do financial statement analysis of any company? So through financial statement analysis, you get a clear picture of company's liquidity position. So you get to know that whether a company is in a good position or in a bad position. And most of the investors do financial statement analysis. So through that, they can easily invest in any company. So ratio analysis include liquidity, which is current or quick, solvency, which means debt to equity ratio, profitability means net profit, return on investment or return on equity, ROA, activity ratios means inventory turnover. Then there is a fund flow analysis, which is analyze the sources and uses of funds, working capital changes. Cash flow analysis focuses on operating in investing, financing cash flows. And dew point analysis is break down ROE, which is return on equity, into profitability, efficiency, and leverage. Now, cost accounting tools. So, cost accounting tools are used to prepare cost sheet. Okay, so there is a accounting called cost accounting. So if you are doing or if you have done your BCom, then you know that there are many types of accounting that we learn in BCom. There is financial accounting is there, management account is there, post and management accounting is there, and post accounting is there. So preparation of cost sheet, which includes prime cost, factory cost, cost of production, and cost of sales. Then marginal cost, that is contribution, PV ratio, break-even analysis, and margin of safety. Post volume profit analysis, which focuses on relationship between cost, volume, and profit for decision making. Then comes standard costing and variance analysis. Standard costing, which means predetermined cost for control and performance measurement. And variance analysis, which is a uh, analytical formula, which is based on analytical formula, most probably used in cost accounting, which can be material variances, it could be price variances, usage variances, labor variances, it could be rate variances and efficiency variance, overhead variances, which could be expenditure efficiency, capacity, and volume variances or variances. Then comes financial management. So financial management is totally different from accounting. Basically, financial management is a part of finance of a company, and accounting is a totally different part of it. So we will going to see the concept and functions of finance. So managerial activity concerned with planning, procuring, and controlling financial resources of an organization is called financial management. What are the functions of financial management? So it is estimating financial requirements. It will focuses on capital structure decision like debt versus equity mix. It will focuses on investment decisions like capital budgeting. It will focuses on financing decisions like sources of funds, dividend decisions like payout versus retention, and working capital management. Capital structure. So capital structure is a mix of debt, equity, preference capital used to finance asset of the company. And here are some theories in financial management, which is net income approach, in which more debts than lower cost of capital and higher firm value. Then net operating income approach, which is capital structure is irrelevant, firm value depends on operating income. Traditional approach means optimal capital structure exists, moderate debt is beneficial. And Mothgilani Miller, which is theory approach, in perfect markets, capital structure is irrelevant. With taxes, value increases with more debt. Cost of capital. So cost of capital is the cost of debt, cost of equity, and cost of preference capital. And weighted average cost of capital is equal to weighted sum of all sources. Now, budgeting and budgetary control. So, budgeting is estimating future financial needs and outcomes in measurable terms, and budgetary control, which means comparison of actual performance with budgeted figures to monitor and control operations. So, here are the types of budget like operating budget, financial budget, cash budget, flexible budget, capital budget, sales, production budget. And budgeting process start with setting objectives, then preparing budgets, then execution, then monitoring and feedback. And here comes the leverages. So there are operating leverages, financial leverages, and combined leverages. Three types of leverages are there in the finance. So what is operating leverage? So it measures sensitivity of earning before interest and tax to change in sales. Then financial leverages focuses on sensitivity of earning per share to change in earning before interest and tax. And combined leverage will focuses on measures sensitivity to earning per share to change in sales. Okay. So operating leverage focuses on cost structure, financial leverage focuses on financing structure, and combined leverage focuses on overall effect of operating and financial leverage. Now, EBIT and EPS analysis. So shows effect of financing options, debt versus equity on EPS at different EBIT levels. It helps decide whether debt financing improves shareholder value or not. Then financial break-even point and indifference level. So what is financial break-even point? So level of EBIT at which EPS is equal to 0 from just covers fixed financing charges like interest and preference dividend. Okay. So with this, we are completing our unit number 4, which is include accounting and finance, which is a very small unit. You can refer it to that. And if you want any types of note, then just comment down below so that I can provide you the notes. So thank you for attending this lecture.